Thank you for coming. I'm David Scherer, Michael's partner. I'm going to take you through a little bit about Fund 1 and Fund 2, and then a lot of people who are in Fund 3, that'll be the last thing I cover, and that's obviously forward-looking. In September, I was asked to be on a panel, a RIA panel, it's a real estate investment panel, to talk about the election. And I said to the person who invited me and two other people, that's going to be a really boring panel because we kind of know who's going to win the election. That's how bad I am at predicting this stuff. And it's going to be more of the same, and it's kind of a short panel. Well, obviously that's not what happened, and the panel wound up being much more relevant. But I'll tell you that everything that, for what it's worth, Diane said it a lot smarter than I did that day, but I almost echoed what she said, which is, look, what do we know so far? We know that interest rates are up 30% across the board. And by the way, in our models, we build them in. They're integrated into every mathematical model we have. And then we're told that growth is going to be a lot higher. And I'm not so sure of that. I think there's a lot of policies that aren't good for growth. I agree with Diane. Limiting immigration is bad for growth. You can have a political view on it. I'm not political. I just know it's bad for growth. When I buy or Michael buys a multifamily unit, we need people to occupy it to then drive the rents. We need population growth. And so those are the things that we're operating at a macro level. I'll also tell you that since the election, real estate, and we're in 8 cities, and we own in 8 cities, and we're bidding constantly in 8 cities, real estate's down anywhere from 2 to 5%. Now, you're also getting dividends and everything else, but we've processed the same information as the stock market and come to a wildly different conclusion. Stock market's up 5 to 7%. I tend to believe that assets correlate over time, and that's my investment life that I've seen, and more so ever. It's trending more that way, not less. Decoupling was something we heard in 07, right before the massive recession. It was, everything's decoupled, and I was like, well, wow, actually, everything's linked. And then lastly, I'll tell you this. What I said, because when I was done saying, well, it's ambiguous, maybe I have a future as an economist, I said, look, we don't care, number one. Like, I'm not going to go to work. It's fun to talk about this stuff, but as a business owner, I need to figure out a way to have a competitive advantage that's sustainable and enduring. And everyone who's in the room needs to do the same. Does it really matter at the end of the day to you as a business owner? Maybe on the margin, but probably not, and you certainly can't control it. Number two, and this is a little bit counterintuitive, but if you think about it, I want there to be a recession. I want asset prices to go lower. I'm about to buy a lot of real estate, and my entire business, Michael and I, this team's business, does way better in inefficiency. And inefficiency is caused by disruption. And that's a space that we're really, really comfortable in. So if you start seeing some of these things happen, know that we're quite happy that they're happening. That's the environment that we want to be in. So this is for our Fund 1 investors. And I'm going to cover quite a bit of material, and I'm going to try to be brief at the asset level. But please, if you're in Fund 1 and you want to go deeper, I'll be here and the team will be here afterwards. So just starting with invested capital, 19 million. It's a little bit more complicated than that because we actually invested 50 million of equity into Fund 1, and that's because there were a lot of co-investments. So when we're trying to diversify a fund across 11 assets, not every asset is going to be a $2 million investment. They come in all different sizes, so there's a lot of co-investment. Michael and I invested a lot more of our own capital, and our larger investors also participate. And that's true in Fund 3 as well. So who gets a chance to co-invest at the deal level? Our fund investors. I mean, they're the ones that get the calls and emails, and that's the way it's always been. So 50 million was invested, but just from a multiple standpoint, we'll focus in on just the fund. 19 million of fund capital was invested. Thus far, just under 39 million of fund capital has been returned. So simply put, if you put in $1 million, you've gotten a little bit more than 2.1, 2.2 million back. That's your multiple on equity. And then the gain that's stated here, again, the fund gain, not the total gain, is 22.7. And again, if you have any questions about this, please ask me afterwards. The net multiple is the net multiple on investment again. If you put in $1 million, you've been returned $2.2 million at this point. The average gross return at the asset level was 34%. What I'd like to focus the most on, you look at the bar graphs, is the standard deviation of returns. And we talk about this a lot, but let's go all the way back to the beginning. The firm was founded to invest me and Michael's capital, and then it's grown over time with investment partners. Our job is to protect capital. And sometimes people say, well, wait a minute, you've gotten a lot of returns, you must be risking a lot. We don't believe we are. We believe we have a competitive advantage. We don't take a lot of asset level risk. We don't take a lot of debt risk. If we did, you would start to see in the standard deviation of returns wild dispersions. And you see that a lot in private equity and leveraged buyout funds. You might see three investments that make 0, 3 investments that make 4x, and you wind up doing just fine, but it's a bumpy road. You will see that most of our returns are clustering. We had a couple outside returns to the upside, but if you take away the 56 IRR deal and the 57 IRR deal, and you move those down sort of to the 30s, there's a lot of action around that median line. And that's what we want. I can't promise what the market is going to do, but I can promise it will outperform what the market has available. And that's what we have done. We get that question a lot. You've done really well in a good market. That's true, but we've also been a top 10% manager for 7 years in a row. And that's what we're proud of. That's outperforming our peer set. And that's what we can do. I can't tell you it's going to be at 25% or 15%. Or 10%, but I can try to be in that top 10%. So last year, for the folks who were here for the update, we always do a cash flow projection. And that was based on, in this instance, Fund 1 had a lot of assets that were through their business plans. We believe an asset is through its business plan when our hold-sell analysis shows us that the point forward expected value is way less than our cost of capital. And that we're constantly running these. You're not paying us to build value and then charge you to create a dividend of 8%. You're paying us to try to target our return, and if the value of the asset is a point where the point forward return is 8, we sell the asset. That's why you see a lot of shorter hold periods. We give you your money back, and you'll see that in Fund 2. Last year we sold 4 assets, so I'll focus on those. Marquee Trace is a multifamily in Atlanta, value add that we executed. We sold it, I would say, at peak pricing, very competitive process. One of the things that we really focus on is we want to buy off market, and roughly half of our deals have been off market purchases, meaning either we're buying directly from the buyer or we're doing a restructure and recapitalization where it's not hitting the market. We do buy on market as well, and we get a lot of pricing information on market. But generally, we want to buy off market, and we always want to sell on market through widely marketed. This asset, Marquee Trace, was actually, at the time of sale, the largest participation in the Atlantic market, meaning the most tours, the most activity. And we wound up, obviously, what I would focus on again is the multiple. IRRs are not that interesting because you can manipulate them. You cannot manipulate a multiple. It's impossible. If you give me $1 and I hold it for a month and I give you back $1.20, it looks great. I gave you a huge IRR, but you didn't make any money, right? You want me to give you back $2 or $3. So I would focus more on the multiple line. In this case, it was you made 4.3 times your money. Aram North Point, another sale, Atlanta submarket, multifamily. I'll go more in detail if you want afterwards. But again, the point forward return on capital was 11 or 12%. It was a very easy sell decision. Mark and his team executed a great sale process. Bay Club Apartments is actually the last asset Fund 1 holds. We do have some residual partials from other sales, and I'll get that on the next slide. But Bay Club is our Seattle asset. This is actually an asset that, if it was not in a fund structure, we would continue to hold. It's a very protected cash flow and an upper teens levered equity return. So without the fact that it's in a fund that needs to be liquidated, because the fund itself has an annual audit. It has real expenses, and one asset can't carry that. You would probably want to keep this asset because the cash flow is very protected. Why is it protected? The rental rates today are nowhere near the replacement cost to build. So there's no supply threat to the market. We look at that a lot, right? Especially in suburban markets. If you can get a cash flow, it's fairly protected from those barriers to entry. And by the way, if rents go high enough to necessitate and facilitate new building, you've already won, right? If the rental rate to build is 40% higher, great. I own the product that's going 40% higher. Nonetheless, we'll sell that project this year. It'll be the last liquidation of Fund 1, and we'll also sell some residual assets. I'll cover that next. The last thing is Michael and I decided together that we're not going to charge people, even though we can. It's just we're not going to charge people on a full fund when it's not a full fund. So we've greatly reduced the management fees, I think by about 70% on Fund 1 because it's the right thing to do. It's something to think about from a management standpoint. There's a big difference between operating agreements and the way people behave. We believe that we operate the highest standard of values, and that's why we formed the firm. Kingwood Medical, again, back to, in terms of selling, we're selling on market, but we bought that through bankruptcy. So I could do this asset by asset, but 70% of this fund was sourced off market. So Arbor on Richmond, bought from a special servicer. Special servicer is the workout group of CMBS bond. Giordano's, bankruptcy. Food for Less, bought from a regional bank. We bought the note and then negotiated a deal with the developer in the deed in lieu. Marquis Trace was marketed, mismarketed. It was marketed by the land fund instead of the multifamily broker. We paid $38,000 a door for this one, and we probably should have paid $58,000 a door. Arium North Point, marketed. Bay Club, short sale. Kingwood, obviously bankruptcy, I just said that. Residence at 3292, we finished the project. It was a half-built and failed condominium project in Seattle. Legacy Suites, special servicer, again off market. Marquis Crest, sort of on market, short sale, Bank of America. The reason I'm doing this is if Diane's right, and I felt like she's still here? Diane, are you here? I'm Melissa. I feel like she wanted to say there's a likelihood of recession. We want that. We operate well in a growing economy. We operate equally well in a disrupted economy, and if I had to choose, I would pick the latter. So this is just quantifying what's left of Fund 1. We get this question a lot. If you invested $1 million into Fund 1, there's $170,000 that will be distributed to you this year. I'm really pretty confident in that number. There's not much, there's a 10% confidence interval around that number. The only thing that could increase it, when we sold Kingwood, and if you really want to look at deals and talk about dispositions of deals, if we're selling deals to REITs, to 1031 buyers, to pensions, we've executed the full plan. People ask us all the time, how do you pick your markets? First of all, that's not the full question. We don't just pick markets, we pick sub-markets within markets, right? So we're in 8 cities, but we're not in 8 cities. We're in 5 to 6 sub-markets in each city. Chicago's an institutional market, sort of, right? We want to buy good assets that we can fix the problems, but also in parts of the city that we can then sell to lower cost of capital. So if I execute the business plan with Mark and his team and Michael and the acquisitions team, and we do everything right, but we do it in an area that is not institutional. So let's pick a non-institutional, Washington Park, Chicago. I can't exit the low-cost capital. Who's going to buy there? But it's Chicago, right? And these are the types of things you read in the paper a lot, too. Chicago has no population growth. It's not true. Chicago is one of the fastest growing cities in the country if you just look at it through the lens around the circle of the loop. But then there's massive flight on the south and west sides. Net, zero. So you really have to get deep. That's why we have regional offices. That's why people live there. They integrate in the city so that we can select the right submarkets, the right deals to execute. And not only execute, but execute to the right buyer. The buyer of Kingwood is HCP. HCP is the largest, one of the largest healthcare REITs. That's who we want to sell to. We buy out a bankruptcy. We fix it. We sell it to the company that wants a dividend. That's what they're buying, a dividend. We solve the problem. They get the dividend. But you have to buy it in an institutional area. You can't buy it in a slum of Houston. They won't buy it there. On the deal in Kingwood, we negotiated a 1 year, a little more than that, 15-month period where we could get an additional $2 million of value if we have more leasing. So essentially, if we sign leases where they approve the credit, we can increase that sale by another $2 million, which actually would significantly increase our IRR and multiple. Okay. Fund 2. So Fund 2 we invested in just under 20 months. That's another thing that if you have interest, we can talk about things like the J-curve or basically when you commit to a private equity fund, you want them to make you money and you don't want them to take a whole long time to invest it because you're paying them to find those deals. So we're very proud of our ability to invest into quality deals quickly. Fund 1 was 18 months, Fund 2 was 20 months. We have 3 years to invest it. We're not taking inordinate amounts of time to do that. And that's why if we deliver, it's actually getting round turns on money, which is what we're trying to do. Again, I would focus on the consistency of returns. Now, admittedly, we haven't exited all of these deals because these are 14 and vintage acquisitions. But these are all to business plan, and we have exited enough of these deals that we've already returned 40% of equity. So to return 40% of equity of a fund that really we shouldn't even be done investing per what you signed up for is pretty extraordinary, actually. And if you're in the business, I think you would agree with that. I'll get into some of the deals we've sold. But again, I would focus on the standard deviation. So you want the bar graphs to look similar. You don't want a lot of undulation. That's true of any business. You want smoothness. It shows a lack of risk. And why is that? Number one, we don't take a lot of debt risk. We have strict covenants that we follow along those lines. Why is that? Well, a lot of the deals that we buy because people took too much debt risk. It's good real estate, but they get flushed out. We talked about interest rates going up, debt maturity issues. These are all things that are opportunities for us because our competitors might be misusing debt. We hope that's true, but we don't want to be part of that problem. Secondly is asset level risk, and it's not talked about enough, but in real estate, there's more asset level risk just by the real estate you choose, right? So if I were to tell you I have a great deal, 25 expected value return on a hotel, or I have a multifamily, you don't know any other information. That's all I tell you. The hotel deal should command much, much more return than the multifamily deal, just by the notion of its asset class. We're not in hotels. We're in multifamily. Why? It's a more protected asset historically. It doesn't get disrupted. And that should make sense, right? Hotels are wholly discretionary. You don't have to take a vacation. You don't have to go on a business trip. You do need somewhere to live. That would probably be the last thing, right? Makes sense. Beyond that, you put your banker hat on. You don't want to pay the 25% return if I'm buying empty office buildings. That should command more. But that's not what we do. We buy 75, 80, 85% occupied buildings, and we try to take them to that incremental next place. But we have cash flow the whole time, the ability to service debt, multiple exit opportunities. So when you're looking at funds, the easiest thing to do is first say, what's your debt to equity ratio? Because it's very objective. I mean, the manager should tell you. And more debt's worse. It just is. It's riskier at every level. The harder thing to do is to say, well, help me quantify the asset level risk. That's harder to do. You kind of have to trust the manager or really have a lot of expertise in trying to figure that out. At the asset level, we plan to sell at least 4 assets, but potentially more, and I'm going to take you through some of these assets. Lux we sold last year, so again, bought it, I would say quasi off market. It was a mismanaged sale process, bank owned, REO. It was built as condos in the West Loop. It was probably 50% occupied, but not any serious work really needed to be done. We only need permits probably on 20% of the building. And we took it, and once we completed the light renovations, I mean, to give you an idea of the Chicago audience, this is the corner of essentially across the street from Soho House. So you're picking up on what's happening with Google and Fulton. You're in the Northwest Loop at the corner of Morgan and Madison. So great location, but completely broken real estate, and one of the last condo buildings to clear the market. It cleared the market. We bought it in June of 13. So once we solved those problems, which really weren't that serious to solve for us, rented the retail, fixed the units, put them online, rent growth and demand was quite high. We created a new fitness center. We freed up some units by doing that. But the real win here was in the buy, to be honest. A lot of this location, we were able to buy at the right price, and the sale. And that's something that we're really pleased with because we sold this to a 1031 buyer who had to place money. We valued this at anywhere between 29 and 31 million, and we sold it in the mid 33s. His initial offer was way above where we valued it, and so that makes it difficult because you want to respond and not just say yes, but he kind of had us at hello. And the point forward IRR in this, to us, on a stretch, was a 10, and that's one of the lower ones I've ever seen. So we're thrilled with this exit, and obviously, again, it's not the IRR, it's very high, but to make a 3-1 multiple on money in 30 months is a huge win. And not only that, at this risk set. This isn't development. This was a built building in a great location in the institutional part of Chicago. Other sales this year, Dave Welk and Mark Turner were in Charlotte on Monday to talk about putting Cambridge Corporate Center for sale. This is a building that we bought in 2014 in the university market of Charlotte, and this has been tremendous asset management. We do a lot of case studies, and we do a case study just on this building because Mark and his team, they've just won so many times. This is big block office space. You've got Duke Energy, you've got GM. We put a new tenant in called Red Ventures, which is essentially an outsourced marketing firm, which became a development project because they needed 9-to-1 parking. We had to build a structured parking lot, but essentially they paid for it because it's integrated and amortized into their lease. It's a very complex deal, and we won a lot of times on revenue and costs. So on the cost side, we eliminated, we talked briefly about automation. We're part of that, I guess. I mean, we eliminated all the security at Duke Energy and replaced them with cameras. That's $1 million of value for our investors because for $10,000 one-time expense, we get to save not only $80,000 a year, but we get to capitalize it. It's an ongoing savings, right? So then that becomes a playbook. We do it everywhere, right? We remeasure the building. In doing so, it's 25, 30% bigger to the new BOMA standards. That's not that interesting. What's interesting is the new leases are integrating the load factor of that bigger building. Now we have a building that's 20,000 square feet bigger. 20,000 square feet at 200 a square foot is a lot of money. It's $4 million. So there's a lot of things that you do as an owner that there's a perception that all the value is created on the buy side in real estate. It's not true. Some of the value is, And a lot of value is created once you have a business plan and executing it and reacting to the market as it changes. The third fund will be a little bit larger. I think we've already raised $110 million. I'll get to that. So the co-investment opportunities probably will be less likely because we're not going to go after bigger deals, and we sort of have the equity. But I'll get back to that. 31 million invested. I touched on this, but 12.5 return, that's 40%. You've gotten 40% of your money back, which is really good at this point. Through these sales, Cambridge, Woodlands, Austin Air Cargo, Centrum I'll get back to, Orlando Industrial, and probably a refinance of Iroquois Club. We'll get back to the amount next, but it's going to be significant. 70 or 80% of your equity is going to be returned just through activities this year and obviously last year. Austin Air Cargo, if you recall, tremendous asset, protected asset. It's airport industrial, so it's a logistics play where FedEx and DHL, and they pull up their airplanes to the building itself, and it goes right from the building to the airplane. So it's on the tarmac. Tarmacs are controlled by the municipality, so you'll never buy the land. You buy the building and the cash flow on the land. And so when we initially bought this asset, we asked and received before we closed an additional 15 years of lease. And I believe, Mark, is this an accurate statement, 37 years of purchase? Is that right? So that is now burned down to 34, and we were in negotiations to extend it again. The cash flow is protected. You want to own the building, but you also don't want to own it at a point where it's not financeable to the next buyer, right? And every year that ticks down, there's less likelihood that a lender will lend to a land lease that's a building on land that you'll own for 30 years. Because we weren't able to get the land lease, we'll sell the building while it's still highly financeable, and we'll get the highest price. So that's where we are with that asset. It's been a terrific ride and great cash flow, but we're at the point now where if you continue to have the cash flow, you're going to start to pay for the higher cap rate on the way out. Centrum at Glenridge, this is an asset we may or may not sell this year. Again, this is an asset we have institutional equity. It's a pension advisor that's in the LP, but it's likely that we're going to entertain sale this year. I can tell you again, from an asset management standpoint, this is a deal that is veered wildly from our business plan. We were close to signing a long-term lease with a firm called Cumulus. We're constantly monitoring the credit of our large tenants. We're a lender. When you have a lease, you're a lender. So I'm a lender just like a bank. And we're watching the credit deteriorate of Cumulus because of their debt to equity levels. We walked away from a lease extension and said, we won't sign a lease with you. You have terrible credit. No. And so that then evolved to an extension where we had them in default, higher rent. And they said, well, we're going to leave the building. And we said, okay, great, leave. And it turns out they can't go anywhere because number one, their radio station, it's hard to move. And number two, everyone else sees their credit's not good. So the way that you solve bad credit is you get letters of credit from banks. So now if it goes into bankruptcy, we're not part of bankruptcy because the letter of credit actually protects us from that morass. And Mark, again, led the charge on this whole strategy, but we wound up signing a lease, but we also signed a coterminous with this letter of credit, which makes it actually very good credit. They might go bankrupt, they might not. We're not so concerned about that anymore, but we're going to take this to market most likely this year. Mark and I haven't included this in the cash flow distribution slide, which is the next slide, but it might be sold this year. There's one more issue with extending the lease of Haverty's, which is one of the largest tenants and has naming rights, that we might try to solve as well. Orlando Industrial, as you recall, and there's sidecars in this as well, co-investors. The thesis on this deal was this is average, not great real estate. It's an institutional park, but based on the clear height, based on the functionality, it's not great real estate. It's okay. But we bought it at $29 a square in a market where everything around it is trading $45 a square. So we believe the demand was there. We're going to lease it up, and it was more of a trade than a long-term hold. And that's exactly what happened. We took it from 45 to around 85, and we sold 2 of the 3 buildings. All the equity's been returned to investors, and we own a 3rd building for free. So this multiple, just like all multiples and all IRRs, are based on the actual realization of the full business plan, right? We have a value of the 3rd asset. That's what will create the multiple. The money that's been returned to investors is just simply your principal at this point. Iroquois Club, we just sent an investor update on this, but really pleased with this asset. We bought it at a great price. This is in Naperville. People ask what we look for in deals. We look for Iroquois Club. When you drove up to Iroquois Club, very well located in Naperville, 5 minutes off the I-88 exit, anchored by pretty good retail, not great, but good. And you know, when Michael's a big proponent of suburban multi, for a lot of reasons, but one of them is affordability. You know, not everyone can afford $3,000 rents in the city. Some people can afford $1,500 rents, and where does that exist? But maybe they work in the city. Naperville has great school systems. Naperville has no supply threats at all. It's very difficult to build there, and rents don't support it, right? So again, barriers to entry, we like that. So this asset itself, you know, because I'm at the 10,000 foot level, that's not where we operate. We buy deals and try to execute them. When you drove up to this, and we did, there was a big permanent sign that said condominiums for sale. It's a 300-unit multifamily. They happened to sell 26 condominiums in 07 and 08. They hadn't sold a condominium in 7 years. What do we look for in real estate? This is what we look for. You know, family run for 25 years, built it in 89. No repricing of rents, literally. You do the lease analysis. There's no reason that's 1,000 and that's 1,300. It's just the way it is. That's what we look for. We look for complaints. I've had investors call me, and I'm sure Mark and his team have, concerned. You just bought this asset, and I see the, you know, all these complaints, and it's online, and I'm like, I know, isn't that great? I love that. That means they're running it badly. I want complaints, so bring them on. I want to see costs that are too fat. And when you underwrite 1,000 deals a year, you see when costs are too fat. It's easy to see, because if we can execute those cost cuts without eroding the value perception, that's the key, right? If we cut costs and you make your renters angry, that didn't do any good. But if you can cut costs without them perceiving any value movement, now you've got something, right? And conversely, we're talking about this today. How can we drive the perception of value the other way? We'll spend money so that people feel better. Why? They'll stay. It's expensive when people leave, right? What can we do that doesn't cost that much money but will keep you here, whether you're an office tenant, a multifamily tenant? These are types of conversations we're having every day. So this asset, if we can buy back the last 4 units, here's the other. There were 26 units to buy back. They sold 26 condominiums. So we're getting a real discount because we're taking that risk. We're not buying 300 units. We're buying 300 minus 26. We have to solve that. That's what we're looking to do. We bought back 22. We have 4 more to buy back. We're in discussions with all of them. We'll get them, and we'll get them at the right price. We're not reaching. But there's a value to getting them, because now I can refinance with the whole market. You know, for the lenders in the room, and they're here, when I have clean title, I have access to lower cost capital. That's what I want. In the meantime, the market's also gone our way. The market woke up and decided that actually people can't afford $3 rents. And lenders are much less likely to lend to new deals at $3 rents because they're nervous. And so now equity and debt's all moving to the suburbs, and they're saying, well, let's look here. It's a lot cheaper to buy, a lot cheaper to rent. And so we've got a lot of wind on our back here as well. And I think we're going to refi out and pull a significant amount of equity out of this deal. And by the way, this deal is 15 months old. This has all happened. A lot of work has happened in 15 months. Okay, so In terms of cash flow, this covers it, but I wouldn't say completely. I mean, there's a lot of more dispersion here. So what this is saying is 27% plus you have to add the 4 through cash flow. 30-ish% of your equity we return this year from activities, whether it's sale or operating cash flow. But there's a lot of things we haven't included. We didn't include Centrum. That might get sold. We didn't include the Re5 Iroquois Club. That could happen. So I would say there's more dispersion around this, and it's more the good way. I don't think it'll be less, but I think it could be more. Fund 3, and I have the slide up too. So committed capital, so capital we've raised as far as $110 million. That's why I said it's unlikely, less likely that there'll be co-investment opportunities. Remember I said Fund 2 invested $115 million? We're not going after bigger assets. That's a mistake. We're really good at the $10 to $30 million space. The market knows us, whether it's on or off market. I'll get into why in the next couple slides. We're not going to then go after larger assets because we have more capital. That's a mistake, and that's how you fail. So that being said, there'll be less co-investment opportunities. So what you will invest in our fund most likely will be what you invest in our fund, and less so what you then co-invest. We've called $23.5 million. I can tell you that we're going to call another $4 million. The Palatine deal isn't currently called, but will be. And then on top of that, we have a deal that's very close to closing in Charleston. It'll be a small GP piece. Pretty excited about it. I'll tell you more about it in a second. And we have a deal in Atlanta that, Dave, is that? It's on, okay. So that's taken a lot of time to do, but it's likely to happen, and that's another $7 or $8 million. So the point is, we've already invested 35 plus or minus million. We'll need to call that extra 10. And then, of course, I think most people know this, but Michael and I use this as our primary investment vehicle. So the GP co-investment, it's not for marketing purposes. It's actually the primary way that we invest. And so we partner with you. And our deal is the same as yours. Ben, the next close is March 30th, is that right? Yeah. So when we say the next close, that means the next opportunity to enter the fund as our partner. And then the final opportunity to enter the fund as our partner will be June 30th, and that's contractual. That's because of the legal documents we have. That'll be the end. Okay. So these are some of the deals that we were talking about. I'm going to focus on just acquisitions for a second. How do you do off-market deals in a market that's not distressed? You do what's called recapitalizations. Lee Park Tower, Cherry Creek are both recapitalizations. So what that means is the ownership group isn't selling the asset, they're staying in, and then we're coming in and participating in the new part of that business plan. Lee Park Tower is a deal that, people talk about the distress in Texas, which is interesting because in Dallas and Austin there's been none. It's actually continued to grow at a higher rate really than any one of our markets. Houston, there's been real disruption. And then if you're in the oil fields, Midland, there's been a lot of disruption. This deal was owned by an ownership group primarily in Midland, and they needed to sell, and they had it under contract twice for $17 million. It fell out both times. Matt Ozzie has a relationship. He lives in Dallas, and I would say that when things are not going well, people like to be quiet and quick down there, and that's what we did. We saw this deal, processed the risk, and this took 4 weeks. Closed quickly, closed at $14 million, and it got appraised at $17 to $18 million. I mean, we think there's a lot of upside in this deal, but it starts with the real estate. It's in the best submarket of Dallas, and the folks who know Dallas, it's uptown, Turtle Creek. We're flanked by $1 million condominiums, a park to the south, a giant office redevelopment. with retail and walkability, everything we look for, but we're the low-cost provider of office. So we have 1975 built office buildings, but they have everything you need: structured parking, access to this market. And so what we're going to do is a light value add, where we are a full $10 to $15 below rent of all the neighboring products. You want to protect your basis because we believe we bought this below the cost of land in the area. So what we're trying to do is create a synthetic covered land play where we get paid money to sit on land. And we think we've done it. So this would be an asset that I reasonably think will hold a long time in the fund, because this is the type of asset that can really create multiple. Cherry Creek gives you an idea of how patient we can be, and I'll sort of touch on why in a second, but when you see 1,000 deals a year, you're patient. You don't have to chase any because there's always another deal. This deal was underwritten 20 months ago. We offered $100 a square. Cherry Creek is sort of analogous to Winnetka, but it's closer. So it's where I would live if I lived in Denver. Great schools, country club, high-end luxury malls, beautiful parks. We actually border one of them. And the tenants in our office, this is 2 office buildings we bought, they're professional service tenants. So they live in the area. They don't want to go all the way to Denver, and it's law firms, and Origin would be there if we, law firms, wealth managers. And so on the one hand, it's a massive management challenge because, to give you an example, remember the building I mentioned in Charlotte we're going to sell? University, the university market, it's called Cambridge. 330,000 square feet, we remeasured, and it's now 390, but we'll say 330. It's got 6 tenants, average size. We just signed a 90,000 square foot lease. Duke Energy's 40,000, GM's 90,000. This is 2 buildings. It's 300,000 square feet, 83 tenants. And so the amount of work, and that's what you're paying us for, the amount of work we're doing, it's extraordinary because they're all 4,000 or 5,000 square feet, 3,000 square feet. They all want to have a luxury experience, right? That's what we're trying to provide for them there. On the acquisition side, we bid $100 a square about a year ago. The owner said, no, I have no interest. That's crazy. I'm going to refi. Fine. We don't chase it. There's always another deal. And so what happened is they couldn't refi. Okay, well, guess what? They're back. What do we pay? $100 a square. Why? Well, because the market's even higher. It's a better buy. And so that's what I mean is you sometimes, this is a 2-year-old deal, but it happens to be in Fund 3. It easily could be in Fund 2. It's the same price as Fund 2. This is our deal activity last year. I think that's one of our competitive advantages. We track everything. 1,000 deals received means we actually processed either the offer on market data. Reviewed means we built a model. Our analysts don't get a lot of sleep. And underwritten means we're questioning the assumptions of the model by doing activity in the market itself. Letters of intent, we have a policy that before you issue a letter of intent, 3 senior team members have to physically see the asset and tour comps. And so that's where a lot of my travel, Mark's travel, Dave's travel, Michael's travel happens. And we try to get ahead of that too. I'm constantly in markets, Mark's constantly in markets, and we're constantly touring. Well, a lot of times deals we bid on, we already have seen, or we saw as a comp for another asset. And then deals acquired, 2 for Fund 2, 5 for Fund 3. So it gives you an idea of what we're doing and what our activities are. And this was a huge initiative last year, and I'm really proud of how the team performed and executed this, because in addition to all the normal things we did, we said, well, wait a minute, how can we get better? We're constantly trying to get better. And what we did is we said, well, we want to source more deals off market, and it's getting harder. So how do we do that? And so we created this off-market database, and essentially, in our submarkets, there's potentially 17,000 properties that meet our criteria. And we sorted through them further, and we said, well, that's too many. Let's look at vintage. Let's look at clear height. Let's look at functionality of office buildings. You know, what's the efficiency level? And we came up, when we used that criteria, with 3,300 properties, 300,000 apartment units, 146 million square feet of office. It sounds like a lot, but it's really not. This is an attainable amount to actually dive deep on, and so we did. And we said, okay, well, what do we need to know? And this is just an example, but this is very, very truncated. This spreadsheet extends to the wall. And what we're doing is we're saying we want to know everything about a property that we can. We want to know the owner, his phone number, the contact, the address, the last price it traded, who owns the debt, when it's due, what major tenants are, who are they. And what we wind up doing is then getting ahead of all this and saying, well, wait a minute, it's off market, but it might be on market later. And we're going to know the market better than anybody. And so this is the new sort of drumbeat at the company, is we want to know these markets better than the people who live there. Now, remember, our people do live there. But I don't live there, right? I don't live in all 8 cities. This helps me, right? And it helps us prioritize what we're doing. What I ask, and please, I'm a broken record, unbelievably talented team, and I ask the same question of everyone, because they're all very smart, we're hardworking. How do we be better than another firm? And then you break it down. How are we better at sourcing? How are we better at asset management? What's our defensible competitive advantage? And if you ask that question every day and you ask it enough, you start to get to the root of what your competitive advantage is. And I think we have. But that said, we'll do it again this year and we'll do it again the next year. That is all I have. And if you have any questions, again, about especially Fund 2, since I didn't have the slide up, I'm happy to answer them. But it's not just me. This team is amazing. And you'll find that the acquisition folks, the analysts, the people in asset management, my partner Michael, everything I've conveyed with you, they know as much or more. And so, you know, please spend the time to see that. Thank you for coming tonight as well.